Profit is often perceived as a dirty word in business. The connotations of the term profit are often of selfishness, greed, capitalism, and finite thinking. Simply put, profit gets a bad rap. The most successful entrepreneurs preach that all businesses should be driven by purpose, not profit, to make the world a better place, to improve the lives of others. Humans need a narrative to tell themselves, a story, to inspire them to leap out of bed every morning. A company should thus be mission-led, guided with purpose, meaning, and aspiration. It shouldn't be about making stacks of money. Not exactly inspiring, would you agree? Whilst I agree with this rhetoric, following this advice literally can be dire. The reality is that without profit, your business is a charity. To create an enterprise, an organization that outlives its founders, you need capital. Relying on venture capital and bank financing is not a long-term business strategy. The only way to be self-sufficient is to generate your own capital. Capital in the form of profit. The next type of profit that all business owners should be measuring is known as net profit. Net profit is a type of profit that I'm sure all of you are familiar with. It's calculated as your revenue less your total expenses. It's generally expressed as a percentage by taking your net profit divided by revenue. Now, funnily enough, there's actually a variation of net profit you should also be paying attention to. It's known as EBIT. EBIT stands for earnings before interest and tax, and is the same as net profit, except as the name suggests, doesn't include your interest or income tax expenses. So why do we do this? So when you want to understand the financial performance of a business, you want to look at the operating profit. That is, the performance of the underlying operations of your business. The problem with net profit is that it doesn't actually give you clarity over the actual financial performance of the business because it can be often skewed by taxes and interest expenses. Let's compare these two companies to demonstrate my point. So as you can see here, the two companies have exactly the same operating profit, but their net profit is different. So why is that? Well, you can see that company A has interest expenses because it has taken on debt from a bank. Company B, on the other hand, has taken funding from a VC, hence there's no interest. Problem is, if you looked at net profit, you would say that company B is actually a better performing company than company A. That's actually wrong. Fundamentally, these two companies have the same financial performance. What differs is how their business is funded. Investors, like Warren Buffett, therefore look at EBIT instead of net profit to understand the financial performance of a company, because he's more interested in the performance of a business, not how it was funded. So, next time you refer to profit, make sure you know which one you're talking about. Are you talking about net profit or EBIT?